Hello, everyone. Tim Harridge here, CEO 2020 REI Group. I want to thank you for taking the time to watch this presentation. This is Loans for Investors. As of today, September 27th, 2018, this is the way we see the loan market and the options that we have available for our customers. We indeed do not know everything, but we think we know a lot. So, to start out with, little disclaimer. You should consider this presentation as for your education only. This is not a commitment to lend. I am not offering money at any certain percentage. We are not raising capital. Everyone is different. Every property is different. Every week is different. As you know, the Fed raised interest rates yesterday. That could potentially have an impact on some of these programs we're going to talk about today. Obviously, the lenders weren't in a rush to, in the agencies and the bond, the people that set the bond prices and the spreads, they didn't immediately rush to notify us that the quarter point, the 25 basis point increase was going to affect the coupon on the 30-year fixed by X percent. So it's always a moving target. Your credit score is a moving target. My wife and I were recently taking one of these 30-year mortgages on a rental property that I'm going to talk to you about. And the borrower in that file, one of us, our mid-credit score came in below 720. It came in at a 718. And those 2 points changed our rates by a quarter point, so 25 basis points. And there's, even with my pool and my clout, there's just nothing I could do. So don't go making financial plans on this presentation. This is a broad presentation presented to hundreds, if not thousands of people. I cannot tell you your specific situation until we have an application and a credit pool and a specific property that we're looking at financing for you. So we're going to talk about understanding lending, the different loan types, different loan structures, fix and flip structures. We're going to go into rental structures. We're going to get into some scenarios, and then I'm going to be happy to take questions. So if you want, you can email slides at 2020rei.com. It's right there on the screen, slides at 2020rei.com. And we will be happy to send you a PDF copy of this presentation. This will be recorded. It will be uploaded to our YouTube channel. You will be able to find it fairly easily. But for now, we're going to get going. So lending to me, and so a little bit about me, if you don't know me, I've done and originated and underwritten and sold and advocated against loans ranging from $5,000 to $100 million and everything in between. And to me, lending is just really a common sense thing. I had a gentleman the other day reply to an email of ours and tell me that he wanted a $50,000 loan and I should not need to pull his credit. I said, okay, $50,000 loan, shouldn't need to pull your credit. Tell me about the property. Well, look, we don't really need to talk about the property. He hadn't found the property yet. It's like, eventually, it's got to make sense. And I always use the mirror test, right? When talking about a loan scenario or a loan ask, look in the mirror and can you say what you're asking for with a straight face, right? I mean, are you asking for a second lien of $100,000 on a $200,000 house that you already owe $100,000 on that you've been trying to sell for 6 months and it hadn't sold? I mean, if you are, that just sounds ridiculous. No one wants to loan money based off of not getting it back. And a hedge fund that I used to work with once said to me, he said, yeah, the whole premise of this business is we need people to pay their loans, right? You hear a lot about loan to own. That's just not the lending business. The lending business works when people pay their loans, right? The point of the business is to give money out for a purpose and to be repaid as promised or agreed. And so I can tell you in this business, relationships matter. We are looking for people that want to form a relationship with us. So I've still got private money lenders that we've been borrowing from for 13 years that every now and then I get to a point where I'm a little low on cash or almost out of cash or my credit line's full at my bank. And it is nice to have the relationship where I can send someone a text message and get a deal done, even sometimes when I'm out of town and they're out of town. So, relationships matter. You really got to just understand that credit worthiness, even if it's not a personal loan, credit worthiness matters. Do you pay your bills back? We had a gentleman the other day telling us how he defaulted on his student loans so that he could get into the house flipping business. And once he made enough money in the house flipping business, he was going to start paying off his student loans. And as a lender, all I hear is, okay, I got someone here that will decide when he or she will honor their obligations if they find something else that their heart desires, right? Because this person, they when they took the student loans, that's what they wanted the most. So then they said they were going to pay them. Well, now they want to flip houses the most. So that's what they want to do. So that's what they're going to decide to pay. Well, as a lender, all I hear is, hey, I hope this guy doesn't decide he wants to buy a Ferrari next month, because if so, he's not going to pay my loan. So anyway, that's the whole point of, it's just use the mirror test. If you're about to ask me or anyone else for a loan, just look in the mirror and say it out loud and see if it makes sense. Loan types. So we specialize in non-owner occupied loans. You're going to hear me say that a lot. These are commercial loans, meaning they are for businesses or business purposes. We have fix and flip loans that are not credit driven. We have some that are credit driven. We have some that are asset based. It varies by market where some of these programs are available. Some of them are regional niche lenders that really only want to focus in certain markets. Some are nationwide. What you find with the nationwide ones are a little less flexible, a little more programmatic, right? We do have loans for single family and multifamily. We have some lenders that'll do real commercial properties, but I just choose not to focus on that. We do have some lenders that will finance mobile homes. Rental loans. We focus a lot on rental loans, and these are non-agency rental loans, meaning they're not the Fannie Mae or Freddie Mac, traditional mortgage that you have to put in your personal name. These are cash flow based, entity level financing. It's going to look at your credit, but it's also going to look at the property with regards to sourcing the repayment of the loan, right? Can the property repay the loan? So, one of the things I like, so you hear me and you'll hear a lot of people talk about commercial loans. And when we first started doing this a couple of years ago, it was always funny because people would say, well, I don't need a commercial loan. I need a loan on a house. And, you had to sit there and say, okay, well, you're looking for a commercial loan because it's a business purpose loan. So just when you hear us say commercial loans, these are all commercial loans because they're for business purpose. They're not for homesteads. They're not for personal use. Many of them, you do not need a W-2 income, almost all of them. Actually, there's very, very few that we have, less than 5% that you need W-2 income. Most of them are built for entrepreneurs, right? Most of them are built for someone that is going to repay the loan based off their self-employment income. And I get it, right? I'm a real estate investor. We're the richest broke people you ever met in your life, right? As far as our tax returns go, we design them to look bad. If someone owns more than 20% of the LLC or the corporation or the entity that you are attempting to procure credit for, we're probably going to have to check credit on 50% of these loans that we're going to talk about. There's a couple of the hard money loans that as long as it's in a company name and the company's clean, our lender doesn't really care. But, specifically for the long-term stuff, if someone's going to get in bed with you for 5, 10, 20, 30 years, they just want to see who has or could potentially have a controlling interest of the entity. Most of our, almost every one of these programs will loan to an entity, an LLC, a C Corp, an S Corp, a limited partnership, etc. Some of these only will loan to an LLC, and some of them will only loan to an entity. There's not many of them anymore that are actually okay putting the hard money loan in Bill Smith's name. So it's just a heads up. We forgot to cover that with one of our customers here recently, and The day before closing, found out that they thought they were taking it out in Billy Joe borrower's name, and so we had to pay for them to get an LLC formed real quick. But it was fine. It was a big deal. We helped them. They helped us. Everybody won in the transaction. Do not take that as I'm on the phone telling you that I want to pay for your LLC, because I really don't. So some sample loan structures. In general, on the fix and flip stuff, we're looking at 70 to 75% loan to value of the after repaired value. On rental properties, when you're going to cash out, we're looking at 65 to 80% of, that should not say ARV, of the as is value, right? Because the reason is, the as is value, you're saying like, okay, it's rented, this is the way it's repaired, and this is the way we're going to look at it. You know, on a fix and flip, LTCs, you're looking at 80 to 100% loan to cost. That means of your purchase price and rehab. So if we've got some scenarios in here later, but I'll tell you, the 100% loan to cost is really hard to get. And I don't even know if I'd want it. I think you need to put a little bit of skin in the game. I think it makes you perform better in the deal. And then 80% unlimited loan to up to unlimited loan to cost of purchase price and rehab. We've got several loan products I'm going to tell you about shortly that do not care how much you have in the house after as little as 30 days. And I'm going to show you some of the ways that works. The fix and flip stuff's, from 1 to 24 months. The rental properties are 2 to 30 years. Fix and flip is all interest only. The rental properties, most of them just use a 30-year amortization. Even if it's due in 5 or 10 years, they're putting it on a 30-year ammo. No real minimum FICO on the fix and flip by and far. We just, but that's only for the ones that loan to LLCs. Really, if you got it below a 620 FICO, we don't have a real valuable rental product for you. I mean, it basically becomes a hard money loan, so you might as well call it that and just do interest only. On our fix and flip money, you range from 8 to 12%. So they're all fixed interest only coupons. Our rental money ranges from 6 to 7.5%. We've got 30-year fixed. We've got 5/1 ARM adjustable rate mortgages. On the fix and flip, we will loan to individuals and entities, and the same thing for rental properties. And you see in here it says 2 to 4% and 2 to 5% on transaction costs. That's your origination and your points and your fees. It's just kind of what the loan's going to cost you. And these rental loans, that should actually be 2 to 6% because some of them do have some pretty hefty underwriting fees. It just depends which program you pick and what you're really aiming for. So on the fix and flip, right, it's really just an interim loan. It's 1 to 24 months. It used to be 12 months. We've got a 24-month provider now. 1 to 24 months, you're looking to fix and flip. Typically, people that are trying to fix and flip are getting a 70% loan. Typically, people that are looking to wholesale, just buy the house, clean it out, put it on MLS, sell it as is, are getting about a 65% loan. And the fix and rent guys and gals that are buying it, fixing it, and then refinancing are typically, trying to max that leverage out to 75% where they can do a rate and term refinance. On your loan to value, all of these loans are between 60 and 75%. We do have some 80% loans, and I'll tell you about them later. But the main, 85 to 90% of what we do is right at that 70% number, really, 65 to 75%. We don't do much 65 right now. Most of our short-term stuff is 70. Most of our long-term stuff is 75. Loan to cost, you should always kind of plan to put 10% in the deal. I know there's some people out there say, "Oh, I'll give you 100%." They don't, or their fees are so high that you might as well, you're wasting profit by doing that. So just a little example there. I got a better example later on. So here's your fix and flip scenario. So you start seeing me put experience in here. And I put experience in here because experience matters. And experience matters not just as a campaign slogan for someone trying to get elected next month. Experience matters because as a lender, if I can see that you have successfully paid other people back, right, and made money, it removes the risk from the transaction with me. If I see you have a high credit score and you have successfully borrowed and paid back money, it makes you a lot less risk of me. If I see you have a lot of cash, a high credit score, and a lot of experience, then you're a really good borrower. And I'm going to stretch. I'm going to pre-approve you for the big time programs, right? A little less money out of pocket, a little more favorable terms, because lenders, rates and fees and points, it only has to do with risk, right? Where is my, because I need to make more money on the more risky stuff. If I told you, hey, take this dollar, walk down the street 2 blocks and hand the dollar to someone and they're going to give you $2, right? Okay, great. That's a 5-minute job and you double your money. Great. Well, if I tell you to take that dollar and, walk from my house in Rockwall to downtown Dallas 23 miles on the highway, and you're going to take that dollar and you're going to get, another dollar, it may not be worth the risk. So it's all about risk return and the amount of time it's going to take and the predictability of getting paid back. So you kind of have 4 scenarios that are just based off of some of the feedback we get from our lenders based off of, experience and credit. And I'll talk to you about the 2 differences too, because all of a sudden you see that it goes from 7 days to 14 days. Now, this is not one of the line of credits. One of the line of credit products, if you're really experienced and you do enough volume, we can get you on there and you can close in 7 days. And if you're experienced with high credit and high experience. But in general, what happens is when you want to move, the faster you want the lender to move, they take more risk. So typically they charge you more. The less risk you ask the lender to take, the less they're going to charge you, right? So here you see the one that gets 14 days and only charges 1.5 points origination and only charges 8.5% interest and has really low other fees and prepaids. Well, that lender is pretty cheap. And he's pretty cheap because that lender orders appraisals and that lender wants to see your tax returns and that lender, expects you to have a, 700 plus FICO score and a couple $100,000 in the bank. So, that lender, also can't move that fast because that lender is not based in your hometown unless you live in one city in the United States. And that lender is relying on local people to do things that it takes time. They have to order an appraisal through an appraisal management company. That appraisal management company has to, then outsource it to a local appraisal. Local appraiser has to get into the house, get the appraisal done, has to upload it, go through 3 or 4 layers of reviews, then it gets into underwriting. So it just takes time. Whereas you look at the mid-credit without experience guy, the one that's charging a 12 and 2 with no other fees, that's someone that's probably more regional or hyper-local that is, a statewide lender, something like that, that is basically going to underwrite it based off of comps, maybe a drive-by BPO, something like that, and they're just trying to make a little bit of money on their money. 6 one way, half dozen another. Me personally, I tend to opt for the 12 and 2 over the 8.5 and 1.5 just because it's quicker and simpler and easier. Now that's only a 70% loan though, right? So if you're talking about capital efficiency and multiplying your equity and all that, then you may want to go for the higher leverage point because in that case you can borrow another $12,500 and it's less out of pocket. And so, you can actually, the argument is that you make a much higher return by paying lower interest and borrowing more money, because then your ROI, you have less out of pocket, so your ROI is higher. Rental structures, right? No owner occupied. If you own part of the duplex and you live in the part, if you own the duplex and you live in half and the tenant lives in the other half, no, right? You cannot live in a property that on a loan that we offer for any period of time whatsoever. We do have a couple of people in our office that are licensed mortgage brokers and loan originators with NMLS licenses. They can help you, but those are not my loans. My company, 2020 REI and its associate companies, we do not do business with homeowners unless we're buying your house. That's it. So I just gotta be clear. Loan to cost. That's right. It's a percent of purchase and actual rehab based on seasoning. So you see here, less than 30 days or a purchase, you're basically looking at 20% down. And your loan to value is going to be based really on all these rental programs. Is going to be based off the as-is value of the property. It's not going to be hey, let's apply for this rental cash-out loan and tell them about all the work we're going to do after we get the rental cash-out loan. They don't do that, right? It's going to be you fix the house or you buy a house. We've been using some of these loan products, buying houses straight off MLS that say, one owner home may need some TLC. It's like, well, hey, this is a great deal. We can go spend $3, $4, or $5 grand and just close straight on the permanent mortgage, save a little bit of transaction cost. And when I say we, I mean me and my wife. So you see kind of a bucket. I've got a better slide here in a minute. I'm going to show you. Well, not a better. It's just kind of goes through a scenario. But just, less than 30 days, you're going to basically be in it for 20% down. 30 days, we can get you 100 LTC or 70 LTV. The rate's a little high. 90 days, we can get you up to 75 LTV, about 6.5% interest. If you've got really good credit, we can get you down to about 6, even into the 5 sometimes. And it's just another thing. So I'm going to talk about this levers, okay? In the rental, in the finance business, in the commercial mortgage business, it's all about levers. You got to pull levers, right? The higher your loan to value you're asking for, well, let's start with you. The lower your credit, right, the more risky. So that lever goes up, right? And then the more loan you're asking for, right, so you want more money. The more money I have to give you, that lever goes up. Well, now if the cash flow is less, well, that lever goes up because now I'm more relying on Billy the borrower, to pay me back out of their own pocket. So one of the things you can do is if you have a property you've owned for 45 days and you just leased it out, you can call us and you can say, hey, look, I just got it leased out. Let's plan to close on day 93. And that way we're into the 90 days and we're getting a better interest rate and a higher LTV. By the way, there is no loan to cost consideration after 90 days. So you can say, hey, look, I just leased it out. I want to wait to the 90-day mark. Let's get it in the hopper. Now, look, if you borrow 70%, you're going to save a little bit of money of coupon. If you have over a 720 FICO score, you're going to save a little bit of money, right? If the property cash flows well and the property debt to income ratio is low, you're going to save a little bit of money. The more risk that is removed from the deal, the better. So one of the things I did recently is I paid an extra point on the loan to buy down the rate a quarter basis point. Because by doing that, I paid a point, which was about $1,400 on this loan. I got a lower rate, and that lower rate made it where I could borrow about $5,000 more because my cash flow improved that much more. So it's one of those things. We can play the game for you. You can play the game. Our job is just to guide you through all the different levers and help you pull them, and always be looking out for better, more consistent, lower price capital or more reliable capital. Cash flow is based on both PDTI, the property debt to income ratio, or the debt service coverage ratio. So it's kind of a little bucket, right? Just to kind of illustrate it out. So if you had this $250,000 house as is, and it was worth $187,000, and you were buying it, it's the same as this flip scenario earlier, right? It's the 250 house that is you're spending $40,000 rehab on that you bought for $147,500. What I'm just trying to say now is, okay, well, we're done with that house. So you spent your $40,000, you're in it for $187,000. What are your refinance options, right? And so I did not do any DSCR or property debt to income ratio factors on this because of the broad variances in property taxes and insurance rates and HOAs, et cetera. There's really no right way to do it. I can say that most of these loans would be doable. So with basic cash flow that I see. So if you want to close pretty fast on the purchase, you can get say you were buying this house for $187,500 turnkey, right? Well, if you put, in this case, $37,500 down, you could buy this house straight on a mortgage, and you're going to pay about 7%. You can pay about 2% in origination fees, about 2% in other prepaids and fees, underwriting fees, appraisal, et cetera. And we can get you basically an unlimited amount of those loans. The minimum FICO is about 620 on that. 30-day cash out. So you want your cash out 30 days after you bought the house. Let's say, you just got a steal of a deal. You went out, you fixed it up yourself. That 30-day cash out's available. The rate's going to be about 7%. It costs about 6% in fees. It's an expensive loan, but literally I can get you. I've got one customer that does about 4 of these loans a month, and it's like clockwork. Bam, bam, bam. It's a 70% loan to value loan, and he rocks it, and he's okay paying the 7% and the 6 points in transaction cost because he is cycling his capital and creating opportunity. And it's got it to where he doesn't even have partners anymore because he's able to cycle his capital so fast. He doesn't borrow money from anyone anymore. Now he's running on about $1 million cash, just adding 3 to 4 properties a month. And he's killing it. And it's in Dallas. You see how the more you want to borrow, or the longer you can wait, the more you can borrow, and the cheaper the loan gets, right? And that's just because risk, right? It's all about, if I'm the lender and I see you've been doing this for 12 months with this house, it shows me you're committed to it. It shows me you've got operating history to it. It shows me you're not just here to make a quick buck and get out of here, right? So my risk is less, so I can give you some more money and I don't need to charge you as much, because to me, that's a better loan. Whereas if you walk in and you're kind of the one-hit wonder 30 days after you've owned a house, like, yeah, I want all my money back, as a lender, I get a little squeamish, right? So I want to kind of make that loan sting a little. That way I don't want to loan you as much, and I want to charge you a little bit more, because that's a way that I see that you really do want to keep the house because you're willing to put cash into it. Once you've had it for a year, you got operating history on it, I'm a little less worried. So this is a model of kind of what my wife and I target and what we do. I took the Main Street model, the house that I used in the other scenarios, the $250,000 house that has $2,000 a month rent, that has an annual insurance of $1,000 and annual taxes of $5,000. Target cash invested, say $20,000. Say I want to buy this house, refinance it, and only have $20,000 left in it, and say it needed $40,000 in rehab. This is a calculator that I use that just kind of helps me know where I need to be. Typically, you see the gross yield is a good little indicator. Kind of shows you what, it's a gross yield is just a real quick number you can run. You just do rent times 12 divided by, whatever your target gross yield is, 0.12. That tells you, or 12%, 0.12, that would tell you how much you can be in the house for. You back your rehab out, you make your offer there. But max basis there, you see that just shows you the most you can be in on this deal in order to refi. and have your target cash in. So these are all buckets. So you see max offer, you just go to the top one because they're bucketed up. I'm not a great Excel builder, but I understand it. So in this case, if I want to be able to refi and only have $20K in the deal, I need to be all in this house. I need to buy this house for $146,250. Because if I buy it for $146,250 and I spend my 40 grand rehabbing, by the time I have all my transaction costs and everything, I'm going to be able to refi it at 175, and I'm going to leave about 20 grand in the deal. And that's just the way it works. And I'm happy to share this calculator too. So here is the way you look at underwriting cash flow. And again, I know I'm kind of going fast. Write out your questions, and I'm happy to jump back to it, right? And just so everybody knows, if you're on this call and you're thinking about build to rent, that we do have some build to rent programs. We have some new construction programs. What I highly recommend you do is that should definitely be a 2-loan scenario. We'll talk about it in a minute in the summary slide. So underwriting cash flow. Okay, so these are commercial mortgages, right? They're business purpose loans. They are designed to where the rental income, the income derived from the property, is the source of repayment of the loan. So what I want to do as a lender is I want to make sure that you're making enough money on the property to pay back the loan you're asking for. It really is that simple of a calculation. I am straight up just trying to ask you, hey, can you pay back what you're asking me to give you with the rent from the property? That way I don't have to look at your income taxes and your personal credit and all of that. So let's just start in the left-hand column, in the middle column, debt service coverage. So let's say the gross rent on a property is $2,000. Well, the lender is then going to back out a vacancy factor, about 8%, and that is 6 to 8%. And that's just, they're going to knock, $160 or, 8% of $2,000. Oh my gosh, my brain is not working. Yeah, I was right. $160. For some reason, it sounded wrong. They're going to knock $160 off for vacancy. And what that means is they're not going to give you credit for that income, because when the house goes vacant, which we all know they do about every 14 months, they know that you need to be saving $160 a month to cover the times that it's going to be vacant. So said another way, if you own the house for 10 years, that's 120 months. You can pretty much expect that house to be vacant 9 months out of that 10-year period. Management. I know you may not pay management, but guess what? If I foreclose on the property and I have to own the property with a tenant in place, I have to pay management. And what I also know is most investors end up hiring a manager once they get to the right size. And then once they get to another size, most investors fire their manager and start their own management company. But you got to model in management. That's about 8%. Some lenders at 6, some lenders at 10. It's 10. That's why it says about 8 on the slide. Maintenance, about 8%, because you're going to spend about $100 to $200 a month on the average rental property. And you may not spend it every month, but over the course of the year, what we know is you're going to spend $2,000 to $3,000 in just either a turn or fixing little stuff around the property. Capital expenditures, those are big ticket items. Central heat and air, water heaters, roofs, foundations, those type of things. We budget anywhere from $450 to $850 a year. Insurance is an actual expense. Property taxes is an actual expense. You got to watch that with rising taxes. If you buy a house in March and you're going to be refining in June, like Jennifer and I did, you just got to be prepared that the tax bill could be higher than you originally planned, which then changes your, the amount you can borrow. And then that just gets you down, to the net operating income, which is just line 1 minus the totals of line 2 through 8. And the calculation factor we're using here in the debt service coverage is going to be the P&I, the proposed monthly mortgage principal and interest payments. So basically, you come to us and you say, I would like to borrow $50,000. Well, the calculation factor here is going to be the P&I on the $50,000 loan. And then what we're going to do to figure out our debt service coverage ratio is we're going to divide line 6 by line 7. And this is just an example here. So if line 6, the net operating income was $1,000, and the payment, line 7, was $750, that gives me a debt service coverage ratio of 1.33. What that means is your net operating income can pay the mortgage payment 1.33 times. So you cover it by a third extra. So many of the lenders, the minimum is 115 or 125. A 113 would be a really, really solid, or 133 would be a really solid. Some of the DSCR, some of the lenders will go down to 1.1. And, you know, just to let y'all know, most lenders typically, they look at a rent and they just ballpark. They knock 30, 40% off, and then they use that number to just kind of see if the loan that you're asking for is going to make sense. Then you have property debt to income ratio, and this is an emerging trend. This is the one I like to use. This is the one that covers the 90-day loans, so it's probably going to be the most common that people have to use. And there you just take the rent. You don't look at vacancy, maintenance, management, capital expenditures, property. You know, the property taxes are added into the payment. The insurance is added into the payment. Any association dues are added into the payment, and that gets you to the PITIA, the principal, interest, taxes, insurance, and association payment. And the way you figure this one out, it's backwards. You divide line 7 by line 6 by line 1. So, an example, if you have a $1,000 a month rent and your projected PITIA is $750, then your PDTI, which is your property debt to income ratio, is 80%. And 80% is a good number. Some of the expensive houses, like 250, I think it's like 190 and up, we can go sometimes up to an 85% PDTI. But try to stick at that 80. If you stick at that 80, that's a pretty solid loan, and normally pretty easy to underwrite and get to. All right. That's just the way you summarize the cash flow calculations. It's just, again, if you have questions, we can come back to the slide and I can go over it. But you really ought to screenshot that. Make sure you get a copy of this, because this is where most people get lost when you start talking about calculating the DSCR or the PDTI. They get lost in this. Some other items that we have access to on a case-by-case basis: transactional funding. If you're looking for 1 or 2 day money, and you're willing to pay a point to a point and a half or a flat fee, if you're going to be doing it frequently enough, give us a call. We're happy to talk to you about that. Short-term wholetail loans. If your wholetail is like in between wholesale and retail, if you're one of the investors that's looking to do that, we can create some loans, some special loan products for you where, it's 8 and 1 if you pay us back in 30 days, but if you pay us back between day 31 and day 60, then it's 9 and 2. But if you go over 60 days, then it's 12 and 2 or something like that. So we do a lot of that, and I've negotiated a lot of it for me. So portfolio loans, there's a very large amount of capital out there for portfolio loans right now. I tell you, the best use of a portfolio loan is going to be if you have a good bank line, really good credit, and a lot of capital and cash, would be just to go fill up, 5 to 10 houses on private money or a bank line. And then you take 10 houses at a time, because that's where you actually have we have some negotiating power with you, because it's a much larger loan. I mean, unfortunately, anything less than $1 million just doesn't really excite people. These big lenders, but when you get into the $1 to $3 million space, you can sometimes lower your rate significantly. Private mortgage sales, if you have any owner finance notes or any of that, give us a call. We've got some investor partners that are buying those for close to 90 cents on the dollar right now. And then lines of credit. If you are experienced and you have good credit, there are some line of credit programs we can get you. I will tell you that it's not a line of credit that it's not like an unsecured line of credit. You can just go draw cash out of the bank because you want to go to Disneyland. It's a guidance line of credit that is secured against the property in any prospective properties that you're looking to acquire. So we have those. They're good products. We have 5 different loan officers at our Division 3L Finance. You can call the number on your screen, 972-737-1850, anytime, and that number will either get you back to the last person you talked to, or if you're a first-time caller, we'll get you to whoever's available. You can always email loans@2020rei.com. It's a distribution list. We all get it. We all look at it, and whoever's available will jump on it first, typically within minutes. So that's really the end of the presentation. I wanted to make it short and sweet, and I'll get into questions now. There's already a couple in the panel. Any seasoning needed for rentals? I think I answered that, but just in case I didn't. You can buy rentals straight with these loans as long as they're in, it's going to be based off of basically 80% of the as-is value. After 30 days, we can get you basically a 7% loan at 70 LTV. After 90 days, we can get you a 75% loan of as-is value at about a 6 to 6.5 rate. Just depends on your credit. If you can wait a year, you can get that rate into the 5s and get you close to 80%. On new construction, build to hold, what I would do is I'd get a private money loan, a bank loan, or a hard money loan at 75%. We've got some lenders that'll do that. I'd build them up and then just do a refinance on one, either the 30 or the 90-day program. Probably the 90-day program, since it's going to take basically that long to build it anyway. The key on that one, though, is you want to get it rented out first, because I know a lot of times you get a premium on these new builds on the rent, and the lenders either like to see actuals or comps. And so it's going to be kind of hard to get comps on something that's kind of speculative. You're welcome. Any other questions? Vacancy on the new build? How do you mean the vacancy factor, or maybe I don't? Okay, yeah. I mean, same. Yeah, they're gonna underwrite the vacancy on the DSCR the same way, because it's still a house that's going to end up going vacant at time. Owner finance versus rental. There are not any lenders that are going to consent to you selling the house to someone else without their permission. There may be some banks. There are some banks in town that do that if you have their permission. By and large, this industry as a whole, anytime someone's teaching sub 2 or telling you to get a rental loan and then owner finance it, they're basically telling you to be a liar because you're violating the due on sale clause. So don't tell us you're owner financing, because if you do, we're going to tell the lender. But I highly recommend, if you're going to do that, go to the bank. There's a couple banks in town. And they need to know that you have the capital and that you're going to wrap the mortgage, because that's what owner financing is wrapping the mortgage. Yeah, we're going to be doing some more webinars in the future. I mean, we really want to do this once a month and have it more as an update, where we update on the on the stuff, on the programs that are out there. Probably start just doing it as a YouTube video and then posting it online, and then letting people ask questions there, so that A lot of people are like, oh, I can't do it in the middle of the workday. That's kind of where I'm leaning towards. How will the line of credit be secured by real estate? It's called a guidance line of credit. So it's basically they look at what you have and what you get, and then they give you a conditional box that says, hey, okay, if you go out and you buy this house at this price or this type of house at this type of price point in this type of area, we'll fund it with these terms. And then you find 123 Main Street, you email the submission paperwork over, which is a rehab scope and a contract and a title company information sheet. And then from there, a lot of line of credits are doing BPOs. So 3 or 4 days, they get a BPO back. We have one line of credit that's just using a online desktop underwriting software. They get the BPO back. That establishes your loan to value, and they fund the deal. So it's secured against every new property. What some investors do, though, to get liquid is say they have 5, 6, 7 houses that they already own. They kind of, it's called back lever. Say they paid cash for them. They just put those on the line of credit at the close of the line of credit. And then that's how they grow their business. No, these loans are not restricted to DFW, and I probably should have been more clear about that. These loans are available nationwide by and large. I'll just say that every deal is different, every neighborhood's different, right? The loan that's available in the Dallas County probably isn't going to be available in Killeen, Texas, right? There's probably going to be a loan to value difference. The loan available in Dallas should be available in Nashville. The loan available in Nashville should be available in Baltimore, and so on and so forth, right? That's why, I put major market. No, they are not. Now, the rentals are nationwide, and, we've seen a lot of people going into even the Midwest and, Cincinnati and St. Louis and using these products very successfully because loan to value is there. You can buy houses a lot lower loan to value. How is the loan to value different from hard money? I mean, how's the line of credit different from hard money? It really isn't. I mean, it's the same way banks do our lines of credit. I mean, it's a guidance line. They'll loan you up to $1 million and up to this loan to cost. And typically you get your interest rate set. So there is a bit of a market hedge there. And it's committed capital, right? As long as you perform within the box, it is committed capital. Any other questions? Excellent. Well, I appreciate everyone's time. That basically gets us to the end of our time. I hope you have a wonderful day. And please, like I said earlier, just check out 3lfinance.com. Visit us call us at 972-735-1850 or email loans@2020rei.com. And one of our 5 loan officers will get back to you very promptly. We look forward to making you customers.